Good morning. We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories this morning. Asian stocks tracking gains on Wall Street as President Trump delays auto tariffs on Mexico and Canada and signals he's open to additional exemptions.
Bonds, meanwhile, are under tremendous pressure. That comes, of course, after that massive pop in German yields overnight, jumping the most in decades on plans for higher defense spending.
Chinese stocks in Hong Kong are on track for a 3-year high as investors digest the government's economic targets. The heads of the central bank, securities regulator and key ministries set to hold a briefing today.
Plus, we hear exclusively from the ARM CEO about Malaysia's $270 billion goals for its chip industry. A very good morning to all of you. Thank you for joining us today. It's a good day to be in the equity markets. It's a terrible day. Well, if you count it going back to Tuesday, really bad successive days, a really massive move up in yields here. So I think the story is when you look at bond markets, you look at Australia, for example, the 10-year there, the 10-year in Japan, you haven't seen these levels since 2009. Massive move up and melt up in yields across Europe overnight, everything from 12 basis points, which was really, if you think about it, the outperformer, all the way up to 20 basis points, depending on which part of the curve and which part of Europe you're looking at there. Just a brief mention before we look at bonds in closer detail here. Brent crude is seeing a slight bounce in the early goings of Thursday. Although that being said, at about these levels at 69.50, that effectively puts global oil prices at late 2021 levels. The euro is very much in focus. Yep, if you're not looking at that, yeah, that's not a mistake there. That's 108 on the euro right now. We are on track possibly for the best week for the euro against the U.S. dollar, specifically in about 10 years or so. Euro-yen, as you can see, also very much in focus here. So a glance at points right now, so that's a 2 and a 10 futures. We're down still in the Asia-Pacific. Massive move up in equity markets there. Of course, this convulsion we're seeing in European markets is how our colleagues put it over in Europe. China overnight, that's the other story we're tracking here. Of course, massive move, 6% to the upside on the Golden Dragon Index. EVs, truck makers, the big tech. Also, some massive moves overnight, so obviously these are the names we'll be tracking going into the session today. It's a big earnings day. We can get to that later, and of course we have this key briefing to tell you about as well in the afternoon session. 0.6 at 1%, so I will bet my unhealthy liver that in about 28 minutes from now, you'll see a new 3-year high on the Hang Seng China Index.
And the other big thing, which you sort of touched on there, is this possible exemption for autos when it comes to President Trump, helping, restore a little bit of optimism. Although, of course, we're still in this sort of whiplash back and forth. Will they, won't they? We're still
What's tomorrow going to look like?
Exactly, like a lot of digestion, right? So, President Trump, more details on this, is giving car makers this 1-month exemption from newly imposed tariffs on Mexico and Canada. It confirms earlier reporting by Bloomberg and comes after the heads of Ford, General Motors and Stellantis met on Tuesday with U.S. officials. Let's bring in Bloomberg desk editor Jill Desis. Just first, on the latest on tariffs.
Yes, well, I mean, as you said, I think quite a bit of whiplash over tariffs over, certainly the last few months. Ultimately, what we're looking at here is, that exemption until about April 2nd. The whole point of this exemption would be effectively to have, the opportunity for these automakers to continue to shift production into the United States. That's what Trump wants. So that's certainly what they've sort of intimated to Trump that they want to try to do, invest, billions of dollars in the U.S. How much that's actually capable of doing over the course of a month, I think kind of remains to be seen. But the fact of the matter is, were these tariffs to actually go into effect on these auto parts, you were looking at potential, increases of somewhere, in the neighborhood of thousands, if not more than 10,000 U.S. dollars on certain types of cars. Particularly, I think EVs, we looked at some recent reports suggesting that you could have been looking at a 12,000 U.S. dollar increase in the price of some of these EVs. We're talking about massive pain points, for supply chains, for production. So at this point, they have this exemption. We're also hearing is that the Trump administration is looking at additional carve-outs, potentially for some agricultural products here and there. So I think the really big takeaway here is that, these blanket tariffs, obviously have really been something of a jolt, over the last few days, but it doesn't really seem like the story is ending there, at least for now.
No, and, just I guess, underscore the influence that Trump policy has had. We talk about how China now needs to open its wallet to bolster its economy. They're trying, of course, to save some dollars in the U.S., and Europe's now being forced to open its own wallet on defense spending, and just this massive melt-up in yields in Europe.
Yes, I know. It's really remarkable. I mean, you look at Germany, for example, so you've got the incoming chancellor who's actually considering removing, this really key debt break that Angela Merkel put in place, over the last decade. I mean, something that really survived the Euro crisis, the pandemic, now something that's, under consideration for being removed. Germany certainly wanting to increase defending, particularly, you just mentioned, China's interest in upping defense spending. Well, in Europe, it's a very similar picture where you're seeing Germany maybe wanting to take the lead there. I mean, we just saw, Vance really kind of, the Vice President of the United States, J.D. Vance, really kind of dressed down Europe at the Munich Security Conference recently. Perhaps that's a little bit of an impetus here. But you are looking at, Germany exploring now at this point, pretty remarkable ways in terms of trying to, get the economy going again, really trying to ramp up defense spending. Really does kind of show you how much the Trump administration is making a lot of world leaders think very differently about things than they have just over the last few years.
Jill, fantastic. Thank you so much. Jill Dees is there, a desk editor. Good for the euro, bad for bonds, good for equity markets over in Europe. Let's bring in Shaun Cochran here, head of research at CLSA, joining us here on set. Good morning and nice to see you.
Great to see you again. Thanks for having me back.
I want to start big picture, if it's okay. Europe wasn't on my bingo card.
Yeah, right.
As recently as Jill was pointing out, just 7 weeks ago. How do I need to be thinking about what's happening there?
Well, so you've got two separate angles here, but the primary trigger here is probably geopolitics and military thinking rather than just economic thinking, but it has significant implications for the bond market, which you've seen, which is Germany has always been the idea of the core of the euro. Essentially you're buying the Deutschmark or a German bond when you look at European bond markets, and so now the signal has been sent, which is that there's room to move on fiscal discipline if broader strategic goals need to be met. Certainly that's been triggered by the changes in the way the US is looking at things, and Trump's aggression. He's rightly called out Europe on their defence spending, and now they're being forced to sort of address a challenge which is probably in their best interest anyway, but the bond market will price that.
So to ask about that pricing question, because part of what's been difficult for the Europeans there has been this element of whiplash, or there has been this element of will they, won't they. So we have this freeze on US aid in terms of supporting and their efforts in Ukraine. To what extent are we seeing that kind of reflected in markets, that kind of uncertainty? How do you hedge in this sort of situation?
Yeah, so certainly I think ultimately the bond market made a decision with this sort of news that there has been a shift, and so I think the market has now moved towards a somewhat unhedged view, a view that we've basically changed. Europe is going to spend more money on military, and that has an implication for what is the right price or yield I should be pricing on for European bonds. And ultimately, one of the themes that we think is enduring is that across the world, military spending is going up as each nation is now onto a path of more self-determination.
The equity market iteration of that is, again, a European market, equity market to be more specific, that's done very, very well. China's done very, very well. Can I blame those two? Well, blame those two when I look at the S&P and this pullback of about, not a lot, but 6% is quite something too.
Right,
for the
it's
S&P.
an interesting and complicated question. The last time we were here, we talked about the limits to valuations for the US market. We talked about that markets like China were probably priced in such a way they didn't have to do a lot right to attract investor attention. So that dynamic is unfolding, but of course the way markets work is there's some narrative. The market likes to focus on one idea at a time if it can, and so of course right now you mentioned we're flipping from one idea on a daily basis, but ultimately we had this big US exceptionalism and AI and technology sort of narrative that was driving markets about 6 months to a year ago. We've then had this environment where these narratives reach some sort of natural valuation limit where people start to worry about, I'm putting my own capital here, how far can this story go? Then other narratives start to compete for the market's attention, one of which has been the arrival of DeepSeek in China has made people think, well, can China actually be relevant on the global tech stage? You've then had this shift in the consumption environment, not just in what China's just announced, but also in this European environment of there's money to be spent. That has implications for inflation, nominal growth, the velocity of money, and so that shifts the flows, which means we're seeing breakouts in Europe and in Asia relative to the US as those flows start to turn.
How seriously are you taking some of these risks, which you touched on already, to that US exceptionalism story?
Yeah, so the US is very strongly positioned in terms of its ability to innovate, its ability to some degree, dictate terms to its counterparts globally, just through the sheer scale of the US economy and its dynamism throughout the passage of time. However, once you get, for equity investors in particular, and for bond investors, it's always not just what's the fundamentals, but what's in the price. And so the challenge has been that a lot has been in the price over the last couple of years around the continuation of US exceptionalism, and now that is the process of that unwinding. So the risk is less that the US is a strong economy. It remains a strong economy outside of cyclical risks. They're always ever present. But the risk is more about the relative expectations in price for all of these regions.
Yeah, but good economy, bad market, good company, bad stock, I guess is a good analogy there.
Right.
Short term, do you think these flows continue?
Right. So if I look at China specifically, we've had a breakout, especially in the tech sector.
Yeah.
And so if you're in, for some of the stocks that have led that breakout, they'll naturally consolidate. If you think about some of the pricing on some of these technology ETFs in China, you've seen them really break out. They've had momentum and confirmations in that breakout, but they're well above moving averages. What we'll typically observe in market price action is consolidate those gains. The market's recalibrating. Just not that long ago, it thought it was worth less, and so it's now recalibrating what is the right price. But that creates opportunity for laggards as well. So if I look at China and Europe, I suspect that these are sustainable moves, tactically speaking, but the leaders consolidate and some of the laggards seek to catch up as the interest broadens.
I suspect Dave is going to have plenty more questions on that laggard point that you make, so we'll stay with us, Shaun.
I'm itching.
We'll have more with Shaun Cochran, that's Head of Research at CLSA there, still ahead. We also have BNP Paribas joining us with their outlook on currencies and China's tariff approach. Plus, we'll hear why Barclays Asia Pacific thinks we've seen no surprises from the MPC, with Beijing's policy to remain reactive to geopolitical tensions. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. You're watching The China Show. A very good morning to you. Good morning. You're watching The China Show, and really China's market rally, to your point, Dave, at the very top of the show, very much in focus today. We saw stocks in Hong Kong rise about 3% or so. On the HSCEI, this key level to watch that we're trying to surpass is the number on your screen, 879. Oh, God, it's so small for me,
92.
Dave. Yes, there you go.
Yeah.
That was the highest since 2022. We did not take that out yesterday, but, you know, keep eyes on there to see what happens. Of course, part of this is really supported by these very robust southbound flows that we've seen coming through. We still also have a host of briefings that we're going to hear. We may get a little bit more detail. The regulators, for instance, are going to speak when it comes to the MPC briefing, so keep an eye on that too. And to your point, we did see some really extraordinary hikes and jumps up in some sectors, EVs, tech, and so on overnight. And we have this quite sort of large bumper dim sum bond coming through for sale today.
Yeah, one-year bonds being sold here in Hong Kong. So we'll keep an eye on that and pricing there. And, of course, earnings. We'll get to earnings in a moment here because we are getting some decent names also reporting today. So let's dig deeper into what now for this Chinese rally. Still with us here on set is Shaun Cochran, Head of Research at CLSA. The previous segment, I think we ended by talking about how there is one group of stocks that's really led this quite obviously in the market. HS Tech, I think, is up 20, 25, 30%. CSI is only up 2%. Juxtapose that with what's happening in the U.S. markets, this broadening out of the rally. But the economy is doing well in the U.S. We can't make the same observation yet with China. What's the case for the rally to broaden out in China beyond this concentration of just tech?
So I think there's two elements to it. One is the fundamentals. Will things get relatively better in China insofar as, and Asia at large, insofar as markets tend to focus on the rate of change rather than the absolute numbers. And so ultimately speaking, on the fundamentals, certainly there's clear signals. The signal that we've just received from the Chinese leadership is we're open for business, we care about the state of growth, we want to defend the growth line, we'd like to see a little less inflation, consumption matters, and the quality of that growth matters. So things like the energy intensity of that growth can't be ignored. And what they're really saying is focus on the quality sectors that can create jobs and can create growth for the economy. So there's a fundamental signal there that underpins the willingness of the market to consider a better outlook. That's point number one. The second thing is what we were talking about earlier, which is the relative flows, insofar as if I had to pick where everyone's money has been for the last several years, it's of course been the US, and in particular US technology. One of the presumptions that underpinned that was the idea that the US dominates technology and there's limited role for Asian companies and especially Chinese companies given the geopolitical tensions that we've seen. And what we've seen with the announcement of something like DeepSeek was to challenge the narrative, to say, well, even with less access to the most cutting-edge chips, is there a role that can be played? And clearly the market is opening its mind that absolutely there is a role, and should you be interested, I can walk through why. But that would be the answer to your question.
OK, before we get into the why of that, I want to pick up on this question about momentum and whether or not we can see this broaden out, because we're also talking about this differential between onshore stocks and offshore. You know, in Hong Kong, we've seen this rapacious rally. The CSI 300 has really lagged behind that. And partly that's structural, because we don't have these sort of tech names in there. It tends to be much more old industry. What does it take to see that momentum and that rally enter into onshore Chinese stocks, CSI 300?
Yeah, so for now, we would give it the benefit of the doubt that that's likely to happen, that broadening is likely to happen. When I speak to our technician, he's certainly, when I asked him, what are your key themes at the moment, he said two things, which is one, the laggards in the technology space. So people have got the attention to technology. Some stocks have led. Those that have lagged behind will probably capture attention next as the market looks for other ways to get exposure to a theme that's working. But the second thing is that broadening out. And so if you combine the change in narrative triggered by this technology issue with the policy signals that are coming, then it's logical to presume that the market will give the benefit of the doubt, keep pushing this theme to see how far it can go. So ultimately we would say the confidence in growth and the change in the rate of change expectation, that's what's going to bring the money to China, and therefore, yes, broadening is likely to occur.
And just back to the earlier point you just made there on the how, for example, why don't you finish that thought?
Yeah, so two parts to it. So if we think about the technology side and then the broadening. In the technology side, I remember having a beer with the CEO of an important Chinese AI company many years ago, and the first wave of AI was around vision and voice, and because you could commercialize vision, for example. And my question to him was, the holy triumvirate in AI is compute, data, and algorithm. Which one's more important? Now, my view was algorithm, to which he said, yeah, I think algorithm is probably more important. The reason is that compute is something that's somewhat commoditized insofar as outside of geopolitics, you can buy access to compute. Data, it has natural limits. It's the ecosystem to which you have access to. But most people have access to the internet, which is a pretty large pool of data. So that's unlikely to be the true edge. But algorithm is limited only by the creativity of those involved. If you look at what the DeepSeek team did, they found constraints around compute, less so data, and they had to evolve and be more creative in how they did it, and it had a profound impact on the way the industry looks. So that's the technology answer. On the broadening out for the market answer, another example would be as the market gains more confidence, you see a change in the bond pricing. We saw it in Germany, but we also see it in China, that the yields seem to be moving back up. That creates opportunities for sectors like insurance, where there's some evidence that they're starting to get more interest, which would facilitate a broadening of the rally.
Just a final question then on, that's an interesting point you make on AI, right? In other words, where is the highest value added across the supply chain? Can I use that methodology in figuring out what multiples I should be attaching to certain stocks within those baskets? So if it's algorithms, they deserve the biggest, the highest multiples, and you go down the the spectrum?
I certainly think you can apply it to a degree of the multiple in that companies that have a track record of that creativity are more likely to have a competitive moat or at least sustain relevance in an industry that's incredibly dynamic. Ultimately, the market will tend to price the growth the most, and that would tend to be the market that they're in. The poster child of this has been NVIDIA, where they've had the dominance in the highest growth market, but absolutely it plays a role in multiples because it speaks to the sustainability of the return of capital. The higher your return of capital, the better multiple you can sustain.
Shaun, fantastic as always. I always feel like every time we wrap this up, we still have a couple of segments to go. We can continue this, of course, next time. Pleasure for you to come in, of course, to spend some time with us. Shaun Cochran, their head of research at CLSA. Yeah, here we go. The rally is set to take place here. We are about 7 minutes to the opening bell, and as you can see, some hefty moves to the upside there. We're not talking at 8,800 on the Hang Seng China Index. That should put us at about that 3-year high. Plenty more ahead. This is Bloomberg. Welcome back. It's a day for the China bulls, for equity bulls, in fact, just more broadly speaking. So we are set to hit a 3-year high effectively here on the Hang Seng China Index. Yes, we do have an 8,800 level already on that benchmark, 1 to 2% gains. And, we've had trouble picking out the stocks to watch today because almost everything is up. So, in fact, on that note, have a look at where we are in the pre-market on the Hang Seng Tech Index. And underneath the hood, where you have the likes of Alibaba gaining substantially overnight, Rebecca.
Yeah, tech names, again, perhaps unsurprisingly, but really at the forefront. And this is what we've seen throughout this rally, just a handful of names driving. But as you say, we were just talking with Shaun about what does it take to see that optimism around tech names that has focused very much on the Alibabas, a Tencent, a small handful of names widening out. What does it take to see that momentum spreading also, in fact, to onshore shares, which have been slightly behind and sort of lagged their Hong Kong peers?
Absolutely. I think the CSI 300's up 2-3% year to date, where of course we're about 10 times that return so far there on the Hang Seng Tech Index. Speaking of, we are going to get some clues there as far as fundamentals are concerned for other companies, right? MTR Corp, which of course runs effectively is a developer, but runs of course the train system here in Hong Kong, reports results later today. JD Logistics, JD Health are also on deck in terms of results. The opening bell, 3 minutes away. Good morning.
Good morning and welcome back. You're watching The China Show. We're counting down to the open of markets. Less than a minute off, Dave. And really, as you were saying, an excellent day to be a China equity bull. We are seeing this rally continue through today. We, of course, saw about 6% jump up in the Golden Dragon overnight in the US hours. Does look like we might see that momentum sustained through today.
Yeah, that was the best move, biggest single-day move up on the index itself. Plus, of course, we haven't talked about breadth and turnover. So far this year, Alibaba, some of the EV plays, some of the sort of EV truck makers were also led the gains there. The other pocket that we're watching just very quickly on other stories, right? So you have energy producers because of the drop in oil prices. You have, of course, what's been happening in Europe with the melt-up in yields and what that's doing with the exchange rate, right? So the euro, for example, is still on track, I believe, to set its best week in 10 years there. So euro yen, euro yuan in focus. Maybe the chart just basically goes vertical. 0.6%, so a sizable move. At the open, as we were pointing out, Shanghai crude just coming online this hour here, and we're down, as you can see, we're down about 1.3%. Just checking how clearly you can see that. Let's change the page, please, and the 10-year yield, as you can see, 1.76%. We'll have a deeper conversation on FX and rates in just a moment there. But yeah, here we go. 2.5% on the Hang Seng China Index, which effectively puts us at the highest level here going back, I believe, to 2022, if I'm not mistaken. Hang Seng Properties up. You have the broader gauge, of course, of Hang Seng. HS Tech, yeah, 6,000. We're very near that right now. At 24.1, that's also a 3-year high. on the Hang Seng Index. Right, a couple of big moves. Well, Alibaba, of course, is one that people have been tracking very, very closely. The other one, of course, has been Hua Hong Semi, which has done exceptionally well as far as a semiconductor play over the very short term. Vanke did get its ratings affirmed at B- by S&P. Choong Holdings up 21% yesterday, of course, on the back of the deal here at the Panama Canal. And, of course, Li Auto, speaking of EVs there, as you can see, some upside also in the early goings. Right, as promised, energy plays, lack of energy. As you can see, oil prices are down. And very quickly, we talked about earnings, an earnings list of those that are coming out with earnings today. You have a lot of the JD's group of companies, if I could just phrase it that way, coming through today. Plus, of course, you have MTR and Lehman Paper Manufacturing, of course, among the other names that are set to report later today. So we're just getting warmed up here, Rebecca.
That's right. But look, a lot of focus on Chinese markets and how they're digesting that news out of the MPC. We're joined by senior equities reporter Abhishek Vishnoi now. Abhi, let's start with what Dave and I have really been chatting about already this morning, which is this differential between onshore and offshore stocks. Why are we seeing onshore Chinese lagging offshore, and what does this mean for investing strategies?
Well, this was a syndrome that was there in the U.S. that we, famously know as Mag 7 versus rest of the S&P 500. Now, this is the same thing that's happening in Chinese markets. Onshore markets have less weighting of tech stocks. Offshore stocks have a lot more weighting. And, the darlings of current rebound are tech stocks. And therefore, CSI 300 index has been lagging. That index, in terms of composition, has a lot more old economy sectors. And old economy is still in trouble. I mean, deflation has not gone away. There are risks that China may further slip into deflation. There are long-term problems like debt demographics that mainland deals with. So that's one reason. The second reason, of course, being economic problems like we discussed. The other thing is that, if you look at the kind of money that has been coming in, the money has been favoring offshore stocks. It might be coming from mainland, from outside of China, but offshore stocks are a clear favorite because they're more foreigner-friendly. And it's short-term money. So, there are no capital controls here. This whole setup sort of, gives you a regime where onshore stocks may continue to lag their offshore peers just because they lack tech and just because China is still surrounded by a lot of problems that are way more important for the mainland economy.
Okay, well, that takes us to the story of this week then with the NPC. And, did the NPC do any favor as far as, giving investors a reason to, I guess, revisit some of these onshore names?
Yeah, well, the targets were bold. Markets really liked it, but like you guys were discussing a while ago, the performance of HSCEI was way better than what we saw in CSI 300. Both indexes closed at their day's high, but clearly there is a lot more confidence in holding HSCEI, which represents stocks, Chinese stocks listed in Hong Kong. So that tells you that investors who are more keen in investing in China, but via offshore exposure, are getting the better hand. If you look at this, this pivot to consumption is actually not new. We have been hearing about dual circulation for years. We have been hearing about boosting consumption for years. So there is this lack of confidence, that is still weighing on onshore stocks. That sort of underscores that China needs to do a lot more before, consumer gets confident, before investors get confident about onshore stocks.
Abhishek Vishnoi there, our equities senior reporter. I think we have that graphic. If we don't have it soon, I promise we'll show you that very, very soon here. This is, of course, we did a word count on the number of times consumption was mentioned in the work report. And by and large, really was above and beyond what we've seen in previous work reports, which I guess underscores the consumption orientation of Chinese economic policy, short and, more importantly, longer term. Ju Wang is here with us, head of Greater China FX and Rate Strategy at BNP Paribas. It's nice to see you, and good morning. Why don't we start with the NPC? What stood out to you the most?
Well, we do notice that the mentioning of consumption, the frequency has increased a lot compared to previous meetings. But it is also curious to understand how China going to achieve a better consumption and 5% GDP target at a year where U.S. applies 20% tariff on China. And the fiscal numbers we look at, 4% budget deficit plus 4.4% special LGB and 1.3, sorry, it was 4.4 trillion special LGB and 1.3 trillion of special CGB. These are not exceeding market expectation. So then the interesting question is like, how can China achieve the 5% GDP? My thinking is that, first of all, the confidence on the China's tech and Xi's model of focusing on high quality growth is actually coming back quite a bit if we look at the equity market. So that over the time probably will boost the market confidence that China gonna potentially still gonna be one of the major beneficiary in the next generation of AI technology booms, and that's gonna boost the company's profit here and there. So that's one area that can potentially drive the growth without the traditional stimulus. The second part, I think we need to focus on how the fiscal resources are going to be allocated. Previously, the special LGBs, most of them probably will go to infrastructure type of, spending, right? But we all know that's more on the production side. The past 3 years have proved that prior to September last year, China was easing, there was stimulus here and there, but all these went to the production side, and that's only aggravate the deflationary issue in China. But since September, some of the resources, for example, some of the trading programs and cutting the mortgage rates, these are all shifting towards the property and consumption side. So the interesting question, I think, for this MPC is don't look at the top-down numbers, looking at what they potentially do with the resources. If they start to do what they've been saying, that we're going to support more local government purchase about property inventories of the market, potentially using the 4.4 trillion special LGB, yeah, that's going to boost the consumption or activity confidence more. But for that, I think we are waiting for this afternoon's conference to see more details. Yeah.
As you say, the how bit is critical, and lots of the mechanisms that you just described, relying on optimism in the tech sector, relying on these trading programs, they speak to more of a short-term boost in consumption. Do you see any signs, or do you anticipate that we will also be seeing any longer-term moves to restructure the economy to improve consumption? Because, of course, local governments are incredibly fiscally constrained. They don't have that power to, for example, reform social welfare and so on.
Yeah, I think people often underestimate the power of the mortgage rates in China. Prior to September, the household will pay 5% mortgage rates, and their deposits in the interbank investment is like 2%. And the property price have dropped to 30-50%. That's a massive negative cash flow situation the household were facing. And we already see that property sales improved in Tier 1 city after they lowered the mortgage rates to 3%. If they're willing to lower mortgage rates further towards 2%, I think the household's deleveraging tendency will naturally stop. And don't underestimate the household saving has been increased more than 10 trillion a year since 2019. So there is a stock of huge money looking for investment, and that's over time going to benefit consumption. And for that reason, we also believe that PBOC will stay on the easing track, despite of the recent noise of tighter funding in the interbank market. But if they will need to cut the mortgage rates, they will have to cut the policy rates. Eventually, the short-term policy rates will be lowered towards 1% in our view.
And that brings up a head-scratcher in why the currency has effectively not budged, right? So the current problem is tariffs. The future outcome that we think about is the PBOC might ease. Both those two things point to a weaker currency. Why is the currency not moving?
There's a speculation that there's a Plaza Court 2.0 in the market, even though BNP is not in that camp.
Okay.
But it is interesting to read the market interpret that Trump wants China to keep the dollar RMB below 7.3. We also know, judging from the PBOC's fixing, China itself also want the dollar RMB to be below 7.3. So then the question is, with 20% tariff, if the currency cannot move, how can China absorb the external shock? The good news is that if other economies are willing to do more, for example, the market is talking about Germany doing whatever it takes on the fiscal side,
yes.
So there would be a nice rebalancing away. So U.S. maybe see a bit more fiscal contraction, and hence the stress on higher U.S. yields, that risk will ease. At the same time, euro is going higher. And as a result of that, the renminbi can weaken modestly against the basket, and that naturally take away some of the problem, because U.S. now accounts for only less than 20% of China total exports. So the renminbi's near against the basket, I think it matters more for China exports.
So PBOC will stay on this easing task, but to what extent do you think that the PBOC is also being held hostage by Trump's tariffs and this focus that they have on keeping, stabilizing the value of the currency?
Our observation of PBOC is they are always patient and wait. So each time when they do monetary easing, they always pick the Fed easing window, right? So in January, when the market is expecting Fed not be able to cut rates at all, I think China took a relatively hawkish stance in the short-term interest rate market. But now the market is pricing potentially 2 to 3 cuts by Fed in this year. So if that really happens, that window opens up for China to follow the Fed to cut rates as well.
What do you think, just to ask you also about the rates part and yields, what do you think is behind this recent pullback, minor pullback in yields? Is that positioning? Is that macro? Is that inflation in the future coming back?
It's certainly positioning, because in December, the market was pricing 30, 40 basis point rate cuts. That's pretty much pricing all the cuts potentially going to happen this year. So market was front-running the policy action and got squeezed. And secondly is because in January there was a high anxiety about the tariff and RMB devaluation risk, and PBOC was in a holding mode. If anything, that they probably guided the short-term interest rates a little bit higher. And thirdly, I think the central bank still maintain this stance that they don't want excessive financial risk in the market, i.e., they want the bond yields lower, but in a very gradual way, not like a speculative, excessive leverage long in the bond market. So all these are their key considerations, and all these things happened together in January and February, and that caused the squeeze in China yields. And last but not least, the equity surprise on the positive side, and people must be thinking, okay, maybe I should consider reduce my 1.6% 10-year CGV and invest a bit more into the equity market.
I mean, if you did that, you'd get 2% right now in Hang Seng Index, if you think about it. And this is a single-day rate, not an annual rate. We've boxed you into specific topics. Have we missed anything? What do you think is important as well that we might have missed?
I think we're in a very interesting moment where all these global superpowers are need to rethink about their overall macro framework, right? The imbalance between U.S. and the rest of the world is large. China was running $1 trillion trade surplus last year, but U.S. has this persistent deflation and fiscal stress. So this usually is the moment where the U.S. administration will start to call a rebalancing of global economy, and how that's going to shape their monetary FX policy. That's going to have a big impact on China and Asia. We would say China's policy tends to be responsive rather than preemptive. But if the external factor changes big time, that's definitely going to affect the Chinese policy settings as well as the local sentiment.
Okay, excellent to have you. Thank you so much for joining us. That was Ju Wang, Head of Greater China FX and Rate Strategy at BNP Paribas. And later on in the programme, we'll have more analysis on China's new growth targets, its plans for spending. Barclays Asia Pacific's chief China economist will be joining us in the next hour. And Dave, we'll be able to catch more of you if we didn't have enough of you on the show.
Our apologies. So in about just under 2 hours from now, we'll be hosting this live Q&A. Of course, do join us. The link should be on our website. Our terminal subscribers can should know where to get that as well. So yeah, all things NPC. Send us your questions and please be part of the conversation. It's a big week in China, so we want to hear your thoughts as well on that. Plenty more ahead. This is Bloomberg. Welcome back. You're watching the China Show. Let's talk about Malaysia and their chip industry there. So the country is hailing this $250 million deal with ARM Holdings that will actually see the chip designer establish its production base there. ARM CEO Rene Haas spoke exclusively with Bloomberg in KL about their role in Malaysia's tech ambitions.
You know, semiconductors are complicated, and our ecosystem has really changed a lot. You're seeing many more governments getting involved in strategies and initiatives. Just look at the U.S. CHIPS Act. So I think what you're seeing today from the Malaysian government is a very significant step in terms of turbocharging and kickstarting an ecosystem.
$250 million for, what, a dozen IPs? Put that in perspective for us. How should we be looking at it?
Yeah, I think the way to think about it is typically companies that want to get started building chips are on their own, particularly if they're venture-backed. The government is now providing a Kickstarter, if you will, to the industry for fledgling companies to get started. It's not going to fund entire chip development, of course, but it does start and show government initiative around getting an ecosystem started. So I think it's a wonderful cause.
What does ARM bring to the table?
Oh, for us, it's our intellectual property. ARM is the world leader in compute, and our compute subsystems, which are used for server chips, automotive chips, PC, phones, it allows companies to get started really quickly to build SoCs. So we're bringing that platform.
It's great having the IPs. It is what you do with them that matters most. Where do you see the most potential, and how realistic is it for Malaysia to think it can produce a chip in the next 5 to 7 years?
You know, chips are hard, and designing chips are hard. There's a unique ecosystem here, though, around assembly and packaging and test. And if you look at the most advanced chips being done around AI, not only are the chips complex, but the packaging is complex. So I think one of the advantages Malaysia has is building on a very robust ecosystem and now adding design onto that, which I think they're very well positioned to do.
It is also about the talent gap. How do you bridge that gap, ensure that you actually have the skilled labor to actually make this work?
It's going to take people, obviously. We're going to help. We're going to be doing training. We'll be doing training.
How many people?
Well, we'll be bringing training here with our folks. We're working with universities not only in Malaysia, but universities in UK, US, where Malaysian students study. So we're going to pull out all the resources we can to enable this, and also getting VCs and investors involved to just start this ecosystem.
In terms of the biggest opportunities, and here I mean industry sectors, would perhaps EV be an attractive sector for Malaysia to be identifying or be investing into?
You know, I think EVs are an example. Robotics is another example. Anything around AI in terms of servers and data centers. I think building on the rich assembly capability and testing and packaging, all of those are great opportunities. It's a very rich time to be involved in this, and I think it's going to bear fruit going forward.
Can it build the ecosystem it thinks it can? And what would it take, and what kind of time frame should Malaysia be looking at?
Yeah, I think this is the classic, when is the best time to build a tree 20 years ago? When's the next best time? Today. It's a start. And frankly, it's a start that I applaud the government for doing this. Not a lot of other governments have moved this quickly and been this ambitious. It's not going to happen overnight, but starting this way is a great, great step.
Can Malaysia be the third player after the US and China? Because today in my conversation with the minister, he expressed optimism that can happen.
It takes vision, it takes ambition, it takes will. And you saw in the speeches today a lot of that. So that's a great start, but it doesn't happen overnight, but we're thrilled to be part of it.
ARM CEO Rene Haas speaking exclusively with our colleague Haslinda Amin there. And if you're a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function TV Go. You can also join the conversation by sending instant messages to our team and our guests during our live shows. Please do go check it out at TV Go. There's plenty more ahead. You're watching The China Show. A very good morning to you.
welcome back. Lots of market stories today. We'll start things off with an update of this bond bleed. 12 basis points to the upside on the Aussie 10-year yield. At 150 on the Japanese 10-year, that's a level we haven't seen in 16 years. And I can also tell you, not on your screens, that bond futures are still coming under pressure here in the Asia-Pacific, so I expect yields to tilt to the upside.
Yeah, this sort of melt-up of yields after the back of Germany's plans to ease limits on government borrowing there. If we can flip, though, to the next board, to China, I mean, we really are seeing this rally just continuing today. Of course, onshore still lagging behind, although up, 6-7 there, Dave.
Yeah, that's not a bad day, actually. So, I mean, 4,000, I guess, is the most immediate nice round number to tell you about there. We have taken out 24,000, which effectively puts the Hang Seng Index at the highest level there in 3 years. And, yeah, we've tallied up in the first 22 or 23 minutes of trade. That's the amount that London investors have already bought across the Stock Connect here in Hong Kong. Right. Welcome back. And that's a look at, of course, for those of us that will never be able to enjoy the view from the peak, that's a view of it here in Hong Kong. 2.3% to the upside on the Hang Seng Index. And just to channel, I guess, Gary Barlow and take that from that 1995 hit, is this market back for good, as they say? It's still enjoying the NPC boost, as you can see on your screens. The DeepSeek boost, really, if you want to dig deeper into that. In fact, when you look at some of the biggest movers here still, it's really the very same names. Baba's up 7%, 10 cents, going down to, of course, JD.com, and that takes us into the earnings story today. The other one that we're tracking as far as market themes is this global bond sell-off that's really showing up quite heavily here in the Asia-Pacific. We'll talk about what happened in Europe, what's happening in Europe in greater detail in just a moment. But really, as you can see, this melt-up we're seeing as far as Japanese government bonds here, Rebecca.
Yeah, absolutely dominating, really, in that bond space. So a tale of really two markets, actually, today. In fact, that deep-seat rally on the one hand, driving so much momentum in equities. And as you say, it is really that story. Although, of course, the MPC has failed to thwart it. Perhaps there's another way of kind of putting, framing this whole narrative, right? It's moved the conversation on just from how much stimulus are we going to get. We're now seeing other reasons to kind of for optimism. Yeah,
and I think we did that separately. We did that story count, that word count on the word consumption, and how much that's featured really into economic policy and thinking as it pertains to the Chinese mainland, long and short term. Nikkei 225 going into the last 30 minutes of trade in the morning session. A couple of markets have turned negative right now. Taiwan, of course, has been bobbing around the zero level. That bond bleed you see at bottom of your screens. Of course, it's going to be interesting how the ECB now then frames and how they actually frame monetary policy, given effectively what the market's done was tighten policy with this massive move up in yields, particularly in Germany, right? Let's get a sense of that, really, and how we need to be thinking about the ECB and the bond bleed in Europe and the rally in equity markets and this sort of return of the euro. Yeah, 108, right? Who would have thought? Mark Cranfield is with us out of Singapore with our MLive team. Again, Mark, we were telling our guests earlier on, Europe was not on our bingo card this year. How do we need to be thinking about this now?
1990, reunification. Well, I guess the wall came down in 89 probably is the start. I mean, it's no coincidence that people were talking about German yields rising the most since 1990, because that is a very significant comparison. At that time, as Germany was putting itself back together, there was huge spending to reinflate the economy. The Bundesbank, as it was then, pre-ECB, was tightening policy quite aggressively, and the Deutschmark, pre-Euro, was strengthening rapidly all the time. Fast forward to today, the signals could be very significant. There could be a lot of comparisons with that. European Central Bank today is going to go ahead, most likely to lower interest rates as expected, but the wording could be completely different. They have to acknowledge what is going on here. Of course, This infrastructure deal still needs to be approved, but it's looking pretty good at the moment. There's also a European defence meeting today as well. They seem to be pretty confident they can get everybody on board for that. This is a sea change. This is a watershed moment for Europe, for the euro, for everything to do with monetary policy. It's a very different situation than just a few weeks ago. As you said, not many people had this on their bingo card going into today. So the European Central Bank will obviously see the potential inflationary expectations on that. It is quite possible they will signal that they lower rates today but go on hold for an extended period. That will also be positive for the euro. Equity markets will be looking very closely to see how much is approved in terms of additional spending on defence. That's been a huge driver of what's going on in the European markets in recent weeks. And then you've got the comparison with US as well, where policy is not as clear. People are looking for places to shift money out of the United States. Europe's looking more attractive all the time. And when you have a rising currency, as it looks as though it's going to happen here, that adds an extra incentive for people to shift money to Europe as well. Things are falling into place. We could get European markets outperforming the US by quite a margin this year. And that is, again, not something that everybody expected this year.
OK, Mark, so watershed moment. Just talk us through how that's changing the mindset of investors in Asia, JGBs, but also well beyond that.
Especially for currencies. When you have the euro currency gathering steam the way it is the second most important currency. The US dollar obviously is the biggest reserve currency. Number two is the euro. When the euro moves, it moves everything in its orbit, and its orbit is very large. So there's a G10 space. Just look at what's happening here with people who are so underinvested in the euro. It's not just a dollar story. They were short of euros on cross rates against the Swiss franc, the pound, the Aussie, the Canadian dollar. All of that needs to be unwound, and you're seeing it happen pretty fast. That's a massive, you can see in the option currency markets, the volumes are enormous in terms of people buying the euro positions and cutting out old positions as well. So that's stage one. That affects the whole of the G10 space. Then you've got all the currencies in Asia, which are also linked in various baskets. They all have the euro in their basket, and they'll have large amounts. The Chinese yuan, Singapore dollar, Malaysia ringgit, all to some extent tied to the performance of the euro. So it's pretty good for Asian currencies as well. That probably feeds into good performance for Asian equities, because people, again, they want to see currency appreciation when they're putting their money to work in the region as well. So it's a win-win for people across Europe, across Asia, and it's all stemming from the fact that the euro could have traction here, could go quite a way higher.
OK, Bloomberg's M-Live strategist Mark Cranfield, thank you so much for joining us. And just some news lines breaking across the desk now. South Korea and the US are conducting annual joint military drills March 10th to the 20th. Of course, closely watching how we are seeing those US alliances, the shifting US alliances, geopolitical gyrations playing out, particularly in our part of the world, Dave.
Yeah, this is, some guidance there when to expect that to happen. So, yeah, mark your calendars now. So this is an ongoing briefing, in fact, we're looking at in Seoul, with representatives from both sides, the U.S. and South Korean military, this joint briefing to announce, of course, this plan for, we should underscore that, of course, annual joint military exercises. So not something completely out of the ordinary, but certainly context given where we are as far as the geopolitical conversation as the world does have a slightly more nuanced texture going into, of course, those dates you see at the bottom of your screens. Right. We'll table that for now and continue the conversation on that. Markets, the bond bleed, and of course China coming up here on the shows. Barclays will be joining us to tell us really, why they were not surprised by the NPC's approach to fiscal stimulus, and as of course Beijing has shifted its focus quite noticeably to consumption-led growth. This is the China Show.
The target of GDP growth of 5% fully takes into account the need to stabilize employment, prevent risks, and improve people's well-being, as well as the potential for growth and conditions supporting growth. So, it underscores our resolve to meet difficulties head-on and strive hard to deliver.
Chinese Premier Li Qiang delivering his work report to open China's National People's Congress there. And local media this morning also focusing on China's 2025 GDP growth target of around 5%. Here's a quick look at what we're seeing in Chinese media. Xinhua commentary saying Beijing's growth target is practical and that it underscores China's resolve to tackle challenges head-on. The piece also expresses confidence China will be able to sustain its momentum and remain an anchor in uncertain global economic landscape. And the Global Times editorial we also have saying that citizens can see the steady progress of the Chinese economy from the work report delivered by Premier Li Qiang. The commentary also points out that foreign media have noted China's record in achieving its GDP goals and says the target of around 5% for this year is a show of confidence.
Yeah. Meanwhile, you have the Securities Times reporting that home purchase restrictions in Beijing and also in Shanghai could be removed. That's part of measures to reduce housing inventories. Now, an expert from China Index Academy also tells the paper other support measures may include greater subsidies for home buying, optimizing provident fund policies, and also reducing transaction costs. Now, that's not the only thing on the agenda today. Perhaps the more important one will be taking place in the next few hours or so, where you have finance. Well, effectively, you have the PBOC, the financial chiefs there, you have the securities regulator, will be holding this news conference later today for a preview of what's possibly to expect. Let's bring in Min Min Lo. She's in Beijing for us, our China correspondent. Yeah, Min Min, lay out our expectations here.
Yeah, it's another big presser here because all the big wigs will be there. You have the Ministry of Commerce, the NDRC, the Economic Planner, the Central Bank, the Securities Regulator. Who have I missed out? MOFCOM, did I say that? CSRC, PBOC, MOF. So all of them will be there. Reporters will get to ask questions, but bear in mind that this is a sort of press conference that in the past, they usually pre-screen or vetted the questions beforehand. So it's not a sort of like free-for-all press conferences in the West. So it will be interesting to look out for what questions authorities choose to answer and what they choose not to answer. It will give us a sense of what sort of messaging the government wants to give to the public. From the PBOC Governor Pan Gongsheng, I think we want to look out for what he would say with regards to monetary policy. There's been a lot of speculation as to when China will eventually shift towards that looser monetary stance and at what pace they will do so, because so far the PBOC has been very focused on defending the yuan, and to what extent are they going to tolerate depreciating the yuan gradually as a way to offset against tariff risks, because that was what they did in the first trade war. It seems like they are quite unwilling to do so this time around. So hopefully we'll get more details around that. The MOFCOM is the agency that is tasked with, telling us what the countermeasures are to all these tariffs from the US, EU, and the like. So we'll likely hear more about, China's stance in terms of its relations with the other major trading partners. China likely to continue signaling its commitment to keep its doors open to foreign companies and foreign investors. The securities regulator will likely hear a little bit more details on how they plan to lower financing costs for small and medium enterprises and what sort of support they will give to the private sector to foster the sort of innovation that China wants to see in the tech sector. And of course, the NDRC chair, that's where we want to get more details on how the government plans to implement the directives from that government work report yesterday, and specifically how they would boost domestic consumption, because that's the number one task of the government this year. It's prioritized above promoting those high-quality productive forces. How they will do that, I think more details will be given later this afternoon.
Okay, all of those details, particularly that question of implementation, closely watched by investors today, of course. That's Bloomberg's China correspondent Min Min Lo in Beijing for us. And our next guest believes Chinese government policy stimulus is likely to remain reactive and incremental. Let's get perspectives from Jian Chang, Chief China Economist at Barclays Asia Pacific. I mean, let's start off with that to try and unpick what some of these key triggers are going to be for an increase in policy. Let's begin with tariffs. We're at approximately 30% now after the latest 20% addition. At what point do we need to see more steps in order to achieve that 5%? And in fact, is that 5% even possible at the 30% level of tariffs?
Yeah, so far, China had additional 20% tariff, right? And relatively speaking, I think the Trump's tariff on China seems to be milder than what it has announced on its neighbors and also the rest of the world. And in terms of the tariff impact, and we can also sense a bit from the recent market movement, the actual impact on China may not be as bad as vis-a-vis some of the China's trading partners, right? I think for market trading, for a lot of the activities that we focus on, it's all relative, right?
Okay, so
for example, I can add a bit on.
Yeah, I was about to ask you to follow up more details.
I can add a bit on. It's interesting to observe that while the offshore analysts typically have 1.6 to 2 percentage point estimates of a subtraction to Chinese GDP as a result of a 60% tariff, onshore, some leading experts on trade and supply chain actually argue the impact would be 1 percentage point. So, right, it's much milder.
Right.
Because of the Chinese exports of intermediate goods, unless Trump can effectively close all the loophole, but that actually means very negative for the rest of the world too.
That's right.
Okay, so at what point do the tariffs start to bite? Is it a 40? Is it 50? Is it 60%?
I think tariff already started to bite, right? After all, the tariff is negative for exports, for growth, and also it's deflationary for the economy, for employment, for prices. But as I said, I think when we look at China, when we look at if our focus is global markets, right, it's China assets versus the rest of the world, and it's all relative.
Yeah, it's a delta, right, that market's looking at here. So, well, I think one part of my question is, how do you guys do it? Because, Rebecca made a good point there, So it's the level of tariffs, number one, but also how long those tariffs stay in place. And we don't know a lot about those two things and how it affects the economy, right? So I guess my question is, how do you model something that has so many parameters and extrapolate growth? The other one I want to ask you is, what component of the growth story in China can we attach the highest degree of certainty to right now?
Yeah, actually, I've turned constructive on Chinese exports since Q2 last year.
Okay.
And we published a piece on exports enduring bright spot.
Yes.
Where besides cyclical factors, which is driven by U.S. economy, U.S. consumer demand, also structurally, I was constructive on exports because of, actually all the factors people are talking about now, new markets, right, in the countries in the global south, because of new products, high tech, and the digital, autonomous, and electrical products, and also Chinese companies going global, which also brings in higher exports. So I think to me, at each point of time, there are some certainties in the economy, and now is I think property sector seems that the worst was past. Right, we've seen in the latest NPC, the Chinese government actually reduced a bit of set a softer tone on its restriction on housing supply. And then if we look at housing inventory data, which obviously has been the focus we spoke about for years, and housing inventory, and that seems to have peaked in Q4 last year, with the 80 city housing inventory turnovers at 33% in 33 months in Q4, and versus now down to 24 months on average. And especially in the tier 1 cities, the inventory turnover actually returned to the pre-COVID level. Well, the tier 2 cities is still kind of hanging there, and certainly there's no much change in the improvement in the lower tier city. But I think there are some marginal improvement also on the property sector, although obviously we can always question the sustainability of it.
Right.
And the certainty on consumption, I think, unfortunately, is what we learned from last year, the trade-in program. If you double the trade-in subsidy, say, to auto, you really see a strong rebound in auto purchases from the households. So you have to give sufficient subsidy. I think that's what we learned, the certainty part of it. But overall, for mass market consumption, we have to see a sustained improvement in employment, labor markets, employment and income growth. Are we seeing that happening? Probably not yet, right? The news, you know better than I do, continues to be maybe some downsizing and salary cuts. Also, I mean, the fast adoption of AI and robotics, humanoid robotics. And I think the first rounds of the impact would also be negative for employment and income growth.
Okay.
So I think for each of the components of the Chinese economy,
I was about to say the components of GDP,
and we can always, at each particular time, find some certainties out of it.
Okay.
Yeah.
A big part of that whole question is going to be whether or not China is able to reinflate, or whether we see inflation coming back. If we look at the estimates for the deficit, you know, the Bloomberg calculations at least suggest that nominal GDP is at 5%, which is, of course, the same, practically the same as China's own inflation adjusted. Essentially, the fact that these two figures are the same suggests that perhaps there is very little room, that China is really expecting to see zero or just a little bit of inflation this year. So I want to ask, what is your outlook for inflation, and what is it going to take to actually see inflation coming back? Is there any chance we get to 2% or even 1%?
You're absolutely right. I think clients, equity market have all been looking at particularly two things: China-US relations and tariff. Another would be when and whether the economy will get out of this low inflation or deflationary environment. And by our estimates in Q4 this year, there's a chance for GDP deflator to turn positive. That would be the average of the CPI and the PPI.
Yeah.
Right. So, but then provided that the current kind of the stabilization in the second derivative and in the property sector will continue, and also the markets on the public, the households respond positively to the government stepped up a 300 billion boost to the consumption trading program.
And I'm wondering, a lot of that, because you mentioned CPI and PPI, and you know the PPI is more outward looking, and I'm wondering, you know, Chinese policymakers have told us, look inside, look what we're doing for domestic demand. As an economist, do you spend more time looking inside now than you do at the external environment, or is it the opposite right now? What is taking up most of your mind space?
Yeah, in the past 2 weeks, actually, my focus have been, number one, the developments towards an end of the Russian-Ukraine war. Ever since 18th of February, Rubio and Lavrov had this meeting. And second would be actually data development in the U.S., and because Street has been talking about the U.S. potential U.S. recession, I mean, trading on that, but obviously the data seems to suggest there are more signs of a slowdown. Right. On the back of the tariff, but also a series of presidential actions. So I think these are the two external developments that are very important for euro-dollar, hence for Chinese currency, and also very important for the Federal Reserve movements, which is important then matters for PBOC. Right? So I think market pricing on the Fed cuts now is more than 1 by the time of June.
Yeah.
And then September and December.
3 now.
3 now. And so that certainly opens the room for the PBOC rate cut, right? So despite the central bank, Chinese central bank have tightened liquidity since the beginning of the year, driving a very painful correction in rates.
There it is.
And I believe that the central bank do still want to lower its policy rate. But it was just constrained by all these other multiple targets that it had. Yeah. Including a steeper yield curve.
Well, now the Fed might move and might make the job slightly easier for them. Jian Chang, that's all we have time for today. Thank you so much. It's nice to see you. Jian Chang, their Chief China Economist at Barclays, Asia Pacific. Plenty more ahead here on The China Show. Remember DeepSeek? So there is obviously the DeepSeek week we had at Alibaba moment too. And I'm guessing a lot of people missed this. On WeChat overnight, Alibaba actually put out the latest model here. And there's a lot of details here, but suffice to say, it does seem that this is really impressing the markets on the latest open source reasoning model. QWQ32B. So we'll talk about the performance next, which is leading to the performance you're seeing on your screens. We'll leave you with a look at Korean defense stocks, really on the back of this broader global trend of defense spending picking up. This is Bloomberg. Right, good morning and welcome back to shows. We are just going into the Japanese lunch break where, as you can see, equity markets are on decent footing. Let's call it 1% between the two. The story, though, is really in the bond markets and 1.5% on the Japanese 10-year yield. So we're not alone there. 6 basis points to the upside. That's playing out really across the board in the bond space. Well, yeah, the extension of the global bond sell-off, we're seeing that just about in every single area of the Asia-Pacific, with the exception of China, in a large way. Asia... across sectors, it's a good day to be long these markets. The dollar has been really on the softer side of things, and you can blame the euro for that. And the best week for the euro so far in 10 years, right? So, but granted, we still have a day and a half left, and we have an ECB decision that's coming up as well. Just keep that in mind, of course. But yeah, 108 handle on the euro. Every single sector almost is up. You have energy, though, to the downside. There's oil prices sink to the lowest level here in about 2.5, 3 years, 2021 lows there.
Yeah, that's right. Just taking a little bit of a sort of deeper look under the hood here and thinking about, to your point, about some of the fundamentals we're starting to see in earnings coming through today. So China's boosting its efforts to increase consumption. We're also then looking, of course, at JD.com, a really interesting indicator metric here. It's expected to post its fastest revenue growth in over 2 years. We're joined by Bloomberg Intelligence senior analyst Catherine Lim from Singapore. Catherine, just tell us, what are the highlights here and what really matters? What numbers really matter?
Right, so two parts of the business, the retail and then the logistics. And I think retail, like what you've actually mentioned, we're on the lookout to see whether, towards the end of the year and as the company now gives us some heads up to January and post-Lunar New Year, whether they've actually seen that improvement in consumer sentiment. Now, not forgetting that there is the International Women's Day promotions that's ongoing, and hopefully that's going to try and stir things up a little bit. So on the retail front itself, we're on the lookout for an acceleration, hopefully, in the revenues for China retail. And then margins-wise, hopefully they will be able to actually narrow the margins fall that we have seen in the previous quarter. Logistics is the other one that, the logistics arm of JD.com should be a beneficiary of the increased overseas move by a lot of the Chinese sellers. But we're going to see whether the recent U.S. tariffs took a hit on some of their near-term business.
Catherine, speaking of the ways that the company has benefited from, let's say, the trade-in program, as an example, on economic policy. And the NPC this week talked about how they do want to continue those efforts. Are we expecting the company to maybe, in terms of guidance, to maybe touch on how some of the macro improvements might be showing up in the results in the coming quarters?
So they are definitely a beneficiary of the trade-in policies that we have seen over the course of 2024, and that's going to continue to actually kick in the fourth quarter that they will be reporting. So it's definitely good news for the company that we're going to see more of that this year. But let's not forget that the base is now higher, so the incremental benefits of that may not come through as strongly as what we have seen over the last 6 to 9 months.
Fantastic. Catherine Lim in Singapore for us, our senior analyst for consumer, and tech in the Asia-Pacific, a preview there of JD.com earnings, and really staying on just the broader topic of boosting consumption, which, of course, has benefited JD.com recently. Let's bring in Shuli Ren, our Bloomberg opinion columnist, a big picture view here, and says that, well, Beijing has a plan to spur consumer spending without having to bring out the fiscal bazooka. But I can't help but notice the title of your piece today has John Wick in it, and what the connection is between what we're seeing out of the Liang Hui and Mr. Wick.
Yes. So the key word is services. China believes that the consumption, domestic consumption, is weak, not because there's a demand problem, but a supply problem. The idea is that people have the money to spend, they are willing to spend, it's just the society does not produce things that they want to spend on. And here comes John Wick. And then one thing is that they think that China's entertainment industry is underdeveloped, right? And then last year, they actually brought in the Kanye West, now known as Ye, to perform at the Hainan province. And that one single show, the box office, the ticket sales was over $7 million US dollars. And John Wick is another interesting development. Basically, the fourth edition basically came out 2 years ago worldwide, right? So why is China bringing this in? Uncut, unfiltered. It's because they think that, people going to cinemas, attending concerts and traveling, it can bring in a lot of fiscal money, and then they can boost domestic consumption without spending any fiscal stimulus.
Okay, so the burden that's being placed on the shoulders of John Wick aside, does this work? Can this work?
I think there are some encouraging signs. For instance, the city of Changsha is known as an influencer city. It's actually a 3-hour high-speed rail north of Hong Kong. And what people are doing there is like they are building a very strong entertainment industry. And they're hiring a lot of wannabe influencers as, audience for all the various reality shows. And the city of Changsha has a lot of success on that. And we have seen that, Ne Zha 2, this animation film, is making $2 billion on the global box office. So China does think that, there is some room to grow. But I think one thing that the government has to know, like you cannot develop the entertainment industry with all the censors, right? Like if you want to bring in international artists like Taylor Swift, which Chinese officials call walking GDP, right? She has to come unfiltered.
Okay, so your point right at the beginning was that essentially the Beijing mindset hasn't shifted. They don't believe that this is a demand problem. This is a supply-side problem that can be fixed by producing better products, essentially. Yeah. Can we actually solve the consumption problem? Can we actually transform the economy without that shift in the mindset? Because otherwise it sounds like this is a pretty short-term solution.
Well, if you try to stimulate demand, right, it's going to cost trillions of dollars. And Beijing basically doesn't want to do that. Perhaps the services sector could be a lower hanging fruit because services account for just over half of final consumption. And in developed countries, it's 70 to 80%. So it's something, they just need to have something.
Okay. Have you heard anything this week so far? And granted, we're only 2 days into, of course, a very lengthy sort of economic planning process here, laying out the plans here. The other side to, I think, the question of Rebecca is, wages and job growth and employment, right? Because you have a lot of consumers, they have money, but it's a finite amount. Unless you're able to sort of massage the mindset of people that, job security is fine and your wages are going to go up, then you don't enter this virtuous cycle just yet.
Yes. So obviously, China doesn't really have a plan, right? Because the fiscal stimulus is below market expectations. But I would like to draw a parallel to Saudi Arabia. I mean, Saudi Arabia is developing its entertainment industry. It also has very high youth unemployment rate, which Saudi Arabia doesn't really have a solution for, right? But if you go there, you see that, the entertainment and the movies and everything is going very well. And that keeps young people perhaps happy. MMN was going. So, maybe China can do the same thing, Young people do not really have jobs, but we can watch Taylor Swift. And maybe they will just be a little bit happier and a little bit more, just not so disgruntled.
Okay. Taylor, Eminem.
Kanye.
EA
with Ye. You got that guess?
Is this the secret to making everyone feel better in China today? Shuli, thank you so much for joining us. That's Bloomberg opinion columnist Shuli Ren there. And just some breaking news crossing the desk now. China's Foreign Minister Wang Yi confirmed to speak at a briefing on Friday at 10 a.m.
Yep. So that's just another way of saying we're going to be all over the story. This time tomorrow, given, of course, the geopolitical backdrop. And, of course, there we go. Okay, coming up here on shows, we're speaking, we had an exclusive conversation with ARM Holding CEO. So coming up here is Haas with Haas. Welcome back. You're watching the China Show. Let's talk chips and semiconductors now. So you have Malaysia hailing this $250 million deal with ARM Holdings that will see the chip designer establish this production base in the country. Now, we spoke with the CEO, and effectively they told us about their role in Malaysia's tech ambitions. Here is Haas with Haas.
You know, semiconductors are complicated, and our ecosystem has really changed a lot. You're seeing many more governments getting involved in strategies and initiatives. Just look at the U.S. CHIPS Act. So I think what you're seeing today from the Malaysian government is a very significant step in terms of turbocharging and kickstarting an ecosystem.
$250 million for, what, a dozen IPs? Put that in perspective for us. How should we be looking at it?
Yeah, I think the way to think about it is typically companies that want to get started building chips are on their own, particularly if they're venture-backed. The government is now providing a Kickstarter, if you will, to the industry for fledgling companies to get started. It's not going to fund entire chip development, of course, but it does start and show government initiative around getting an ecosystem started. So I think it's a wonderful cause.
What does ARM bring to the table?
Oh, for us, it's our intellectual property. ARM is the world leader in compute, and our compute subsystems, which are used for server chips, automotive chips, PC, phones, it allows companies to get started really quickly to build SoCs. So we're bringing that platform.
It's great having the IPs. It is what you do with them that matters most. Where do you see the most potential, and how realistic is it for Malaysia to think it can produce a chip in the next 5 to 7 years?
You know, chips are hard, and designing chips are hard. There's a unique ecosystem here, though, around assembly and packaging and test. And if you look at the most advanced chips being done around AI, not only are the chips complex, but the packaging is complex. So I think one of the advantages Malaysia has is building on a very robust ecosystem and now adding design onto that, which I think they're very well positioned to do.
It is also about the talent gap. How do you bridge that gap, ensure that you actually have the skilled labor to actually make this work?
It's going to take people. Obviously, we're going to help. We're going to be doing training. We'll be doing training.
How many people?
Well, we'll be bringing training here with our folks. We're working with universities not only in Malaysia, but universities in UK, US, where Malaysian students study. So we're going to pull out all the resources we can to enable this, and also getting VCs and investors involved to just start this ecosystem.
In terms of the biggest opportunities, and here I mean industry sectors, would perhaps EV be an attractive sector for Malaysia to be identifying or be investing into?
You know, I think EVs are an example. Robotics is another example. Anything around AI in terms of servers and data centers. I think building on the rich assembly capability and testing and packaging, all of those are great opportunities. It's a very rich time to be involved in this, and I think it's going to bear fruit going forward.
Can it build the ecosystem it thinks it can? And what would it take, and what kind of time frame should Malaysia be looking at?
Yeah, I think this is the classic, you know, when is the best time to build a tree 20 years ago? When's the next best time? Today. It's a start. And frankly, it's a start that I applaud the government for doing this. Not a lot of other governments have moved this quickly and been this ambitious. It's not going to happen overnight, but starting this way is a great, great step.
Can Malaysia be the third player after the US and China? Because today in my conversation with the minister, he expressed optimism that can happen.
It takes vision, it takes ambition, it takes will. And you saw in the speeches today a lot of that. So that's a great start, but it doesn't happen overnight. But we're thrilled to be part of it.
That was ARM CEO Rene Haas speaking exclusively with our colleague Haslinda Ahmed there. And just taking a look at Alibaba now, one of the top performers today. It's very, very close to knocking out that high, the highest since 2021. It reached that just a couple of weeks ago. 138.50 is the level that we are watching. Yeah, look, barely any points off just that there, Dave. And a lot of that optimism, of course, has been about this deep competition that's had with DeepSeek and other AI platforms, this race to get ahead. Alibaba also now introducing its latest open source reasoning model that touts a performance that's comparable to DeepSeek. Our tech reporter, Annabelle Jewellers, is with us now. Belle, just first lay out, what are we seeing today and how does it stack up to all its peers?
Well, it's certainly causing a lot of a stir. I mean, the QWEN large language model family was launched back, or this particular branch, QWQ, because today is QWQ32B, but QWEN is their family of large language models, essentially. This is one of the latest iterations of QWQ. That's short for QWEN with questions, and it was first introduced by Alibaba going back to November 2024, and it's an open source reasoning model that was essentially designed to compete with OpenAI's O1 preview. Of course, in the time since, it sort of shifted the competition from OpenAI more to what DeepSeek is doing, and today the announcement very much reflects that, because they're saying essentially this model, which has 32 billion parameters, so much fewer than DeepSeek, for instance, it is capable of achieving the same result or even better performance. So you're essentially getting a smaller size, but a performance that's comparable. And so that is essentially what the company's put out. You're seeing that market reaction to it. This is a statement that the company's put out, again, talking about those 671 billion parameters. They do actually say in a statement that only 37 billion are activated, but they're able to do it with 32 billion parameters. So again, just reinforcing smaller size, less computing power, same performance. Essentially, you know, that seems to be positive for the market.
Yeah, it sounds like my boss. Achieve more with less, right? Isn't that?
I mean, that's everyone's mandate, isn't it, these days?
Yeah, and that's a life mantra, too. Explain the stock price. This is unsurprising move up in the share price today.
Yeah, I think it just reflects how much optimism there is around Alibaba just generally. I mean, you're taking that stock rally now to around 70%. This is a company that's seen as having a lot more tangible results, essentially, and well-established earnings growth prospects, at least in the near term. Yeah. And that's one of the reasons that it's such a standout in the China tech space right now. I mean, there's really a lot of upside, it seems, ahead for Alibaba, not least in this, but also the general turnaround of the business in the e-commerce division under Zhang Fan as well.
What a great story, this Alibaba story. Belle, thank you so much. Belle Jewellers, our tech reporter. If you are one of our Bloomberg subscribers, you can catch this chat we just did, of course, with Belle and some of the interviews and other segments we may have done that you might have missed. TV Go on your Bloomberg terminal. Join the conversation and, yeah, be present, as they say, as we broadcast the news for you. Check it out, TV Go. Plenty more ahead. This is Bloomberg.
Good morning, welcome back. Well, with uncertainties on tariffs prevailing, former US Secretary Steven Mnuchin has said he likes the idea of 10% tariffs across the board. Speaking at the Bloomberg Invest Forum, he also says he's trying to help the administration from the outside.
The market really wants certainty and understanding certainty and will adjust to whatever they are. I think the problem right now is we don't have certainty. My own view on the tariffs would be that if he wants to do something, I like the idea of the 10% tariff across the board. It's a consumption tax on foreign goods. But if he were to do that, he should do that through the reconciliation process, so that can be scored. I think would raise about $2.5 trillion and could be used to pay for tax cuts, as an example.
Speaking of tax cuts, you engineered with President Trump the very large tax cut of his first term. Do you think a similar sized tax cut is essential now?
Well, the biggest focus for them is just extending the personal side of the tax cuts, which are going to expire. And I think that, that was a signature part of his first term. And I think that's got to be the priority to continue. Now, on top of that, I know he wants to do additional tax cuts, and that'll be a little bit more challenging with the pay-fors.
During the campaign, he talked about a couple other tax cuts. One is no tax on tips. Are people getting tips actually paying a lot of taxes? I don't know. I mean, the cash they're getting, I don't know how much they're paying, and maybe they're paying a lot of tax. Is that a big source of revenue or loss of revenue if you don't have tax on tips?
Well, you know, we're not in as much as a cash society as we used to, so there's a lot of tips that go through an electronic mechanism. I think if he wants to have a small carve-out for tax on tips, I think that makes sense. I think, obviously, if you start giving tips to investment bankers at the end of the year instead of bonuses, and they don't get taxed, that would be a little bit more problematic. And you know, you could tax your lawyers, so I think if he does that, it needs to have a small carve out.
In the campaign, he also talked about, I think, no tax on Social Security. Wouldn't that be pretty expensive?
Very expensive.
And no tax on overtime too. I think he talked about. Would that be expensive too?
It would be.
There we go. Stephen Mnuchin there, the former U.S. Treasury Secretary, speaking with David Rubenstein at the Bloomberg Invest conference in New York. Back to markets. So we're still feeling the effects, really, of this bond sell-off across the Asia-Pacific. So yields are up. Australian 10 years up about 11, 12 basis points. These are German Bund futures. Effectively, you're looking at traded actively here in the Asia-Pacific, or at least they have live pricing. Different levels of liquidity, of course, to tell you about. On the 10-year itself, so in other words, do expect this melt up in yields based on the pricing right now to continue going into this comes and intersects, of course, with ECB Day today. But yeah, this is quite something.
Yeah, I mean, pretty extraordinary. And we had an excellent conversation with our colleague Mark Cranfield, putting this into context that really this could be the biggest revamp in spending for Germany since the 90s, which helps give that context. We are at this sort of watershed moment, as he puts it.
This bull market is just hitting new highs here, with the Hang Seng Tech Index, as we speak, is now very close to taking out that 6,000 level. Hang Seng Index, 24,000. We're at session highs as we approach the latter part of the morning session. And yeah, we have plenty more, of course, coming through. This time tomorrow is the briefing from the Foreign Ministry. This afternoon, Asia time, is the joint briefing from, of course, securities officials.
Yeah, we'll get that across the board. And you can get more of Dave today in listening to our live Q&A session, breaking down why China's ambitious growth target is raising hopes for stimulus. Whether or not that will come through, that will be at 11:30 a.m. Hong Kong your time, featuring our very own
James
David
Maker,
Ingles,
Jenny Marsh, and Josh Xiao out of Singapore.
Thanks for joining us today. You're watching The China Show.